In 2008, while millions of Americans lost their homes, their jobs, and their life savings, a small group of people made more money than they had ever made in their entire lives. Not despite the crash, because of it. While the rest of the country was drowning, they had quietly placed a bet that the entire system was about to fail. And when it did, they got paid. Some of them walked away with hundreds of millions of dollars. A few walked away with over $1 billion. So here's the question almost nobody actually answers. When the economy collapses and trillions of dollars seem to just disappear, where does all that money actually go? It doesn't vanish into thin air. It moves. And somebody, somewhere, is almost always sitting on the other side of that trade, waiting. This is the story of who actually profits when everyone else loses everything, and why it could happen again. Most people think of a financial crash the way they think of a hurricane, a natural disaster that hits everyone equally, that nobody could have predicted, and that simply has to be survived. That idea is comforting. It's also wrong. A crash doesn't destroy wealth so much as it relocates it. The money that disappears from a homeowner's equity, a retiree's savings account, or a small business's cash reserves doesn't evaporate. It has to go somewhere. And if you look closely at almost every major downturn in American history, you find the same uncomfortable pattern. A small number of players don't just survive the storm, they position themselves years in advance to be paid by it. To understand how that's even possible, you need to understand one simple idea that most Americans never think about. In the financial markets, you can bet on things going wrong, not just hope for the best and hold on for the ride. You can actually place a wager that failure is coming, and get paid handsomely if you're right. That might sound almost distasteful. Betting against your own country's economy? But it's completely legal, and it has been part of Wall Street for well over a century. It even has a name that sounds far too casual for what it actually represents: shorting. Here's the simple version. A normal investor buys a stock or an asset, hoping the price rises over time. Shorting flips that completely upside down. An investor borrows shares, or in more complex cases, borrows exposure to an entire market, sells it immediately at today's price, and promises to return it later. If the price falls before they have to give it back, they buy it back at the new, cheaper price, return what they borrowed, and pocket the difference. In plain English, the worse things get, the more money they make. Now multiply that idea by billions of dollars. Add in financial instruments so complex that most bank executives at the time didn't fully understand them. And you start to see a financial system where a small group of investors don't merely survive a crash. They're actively waiting for one. But to really see how this played out in real life, you have to go back to the years before the crash, a period that, on the surface, looked like the best economy America had seen in a generation. In the early 2000s, home prices in the United States were rising almost every single year in nearly every part of the country. It felt to most Americans like real estate simply could not lose. Banks were approving mortgages faster than ever before, and increasingly, they were approving them for people who, just a few years earlier, would never have qualified for a home loan at all. These were called subprime mortgages, loans issued to borrowers with weak credit histories, unstable incomes, or in some documented cases, almost no verified income at all. Under normal circumstances, a bank handing out that kind of loan would be taking on enormous risk. Lending money to someone who might not be able to pay it back is, by definition, dangerous. But something had quietly changed the incentives across the entire banking industry. Banks weren't planning to hold on to these risky mortgages for the next 20 or 30 years, the way a traditional bank once would have. Instead, they bundled thousands of individual mortgages together into complex investment products called mortgage-backed securities, and sold those bundles off to investors, pension funds, insurance companies, foreign banks, all over the world. The originating bank collected its fee the moment the deal closed, then moved the actual risk of default somewhere else entirely. Think of it like a car dealership that has absolutely no reason to care whether the car it just sold breaks down on the highway 6 months later, because they were never going to be the ones driving it. And because these mortgage bundles were sliced, repackaged, and resold again and again through the financial system, almost nobody left in the chain had a clear, honest picture of just how risky the underlying loans actually were. The credit rating agencies, the very institutions whose job was to warn investors when something was dangerous, routinely stamped these bundles with the safest possible ratings, the same ratings normally reserved for U.S. government bonds. For years, the system seemed to work. Home prices kept climbing, which meant even a struggling borrower could refinance or sell the house for more than they owed before ever defaulting. Every year that passed without a collapse made the system look more proven, more stable, more permanent, right up until it wasn't. But here's a part of this story that almost everyone missed at the time, and it changes everything about how the rest of the story unfolds. Not everyone on Wall Street believed the good times were going to last forever. A small handful of investors, hedge fund managers, obscure analysts, traders who actually sat down and read the fine print buried inside these mortgage bundles, instead of simply trusting the top-tier ratings stamped on the front page, started noticing something deeply troubling. Buried in loan-level documents were unmistakable signs that a huge number of borrowers were already falling behind on their very first or second mortgage payments. Some loans had almost no meaningful documentation of the borrower's income at all. These investors reached a conclusion that felt almost absurd at the time. An enormous share of these mortgages were going to fail, not eventually, but soon. And if enough of them failed at the same time, the entire multi-trillion-dollar structure built on top of them could come crashing down. So a small number of them did something that, at the time, almost nobody on Wall Street was doing. They went looking for a way to formally bet against the American housing market itself. The tool they used was called a credit default swap. Essentially, an insurance contract written on these mortgage bundles. If the bundles performed fine, the investor simply paid small, steady premiums, month after month, and slowly lost a bit of money. But if the bundles collapsed, the payout could be enormous. Sometimes 10, 20, even 30 times the original amount put in. Banks were more than willing to sell these contracts, because they, too, genuinely believed housing prices would keep climbing indefinitely. From where they sat, it looked like easy, practically risk-free income collecting steady premium checks on an insurance policy that almost nobody thought would ever actually have to pay out. They were wrong. And the small group of people watching quietly from the outside already knew it. Here's where the story gets uncomfortable, because this is the part most people would rather not think too hard about. The investors making these bets against the housing market weren't doing anything illegal. They weren't hacking a system, breaking any rules, or committing fraud. They were reading publicly available loan data more carefully than almost anyone else in the entire financial industry, drawing an unpopular and deeply unwelcome conclusion and having the conviction to act on it, while the rest of the market assumed the party would simply never end. But underneath that story is a deeper, more structural mechanism, one that goes far beyond a few sharp-eyed investors spotting a bubble before everyone else. The entire financial system had been quietly rebuilt, so that risk and reward were completely separated from one another. The mortgage brokers who originated the risky loans in the first place got paid the moment the loan closed, regardless of whether the borrower could actually afford to repay it over time. The banks that packaged those loans into mortgage-backed securities got paid the moment they sold the bundle off, regardless of what eventually happened to it. Everyone further up the chain collected their fee and passed the underlying risk downstream to somebody else. That's the part that almost never makes the headlines, but it is the actual engine that powered the entire crisis. When your paycheck doesn't depend on the long-term outcome of the deal, you stop caring about the long-term outcome. And when millions of individual decisions across an entire industry are all quietly built on that same short-term incentive, the system doesn't just become risky, it becomes almost mathematically destined to eventually fail. By late 2007, the cracks were impossible to ignore. Borrowers were defaulting in numbers far beyond anything the bank's own models had predicted. Housing prices, which had never seriously fallen on a nationwide scale in modern American history, started dropping in city after city. And the mortgage-backed securities that banks around the entire world had been treating as nearly as safe as cash were suddenly worth a fraction of what everyone had assumed just months earlier. Then, in September of 2008, Lehman Brothers, one of the oldest, largest, and most respected investment banks in the entire country, collapsed. It remains to this day the largest bankruptcy filing in American history. Within days, the shockwave spread through the global financial system. Credit markets froze almost completely. Banks stopped trusting each other enough to lend money overnight, which is the basic, invisible plumbing that keeps the entire financial system functioning on a day-to-day basis. Facing the very real possibility of a total global financial collapse, the United States government stepped in with a rescue effort on a scale never seen before. Congress authorized roughly $700 billion for the Troubled Asset Relief Program, widely known as TARP, in an effort to stabilize the banks that were considered too large and too deeply interconnected with the rest of the economy to be allowed to fail outright. But here's the part of the story that almost never gets talked about the same way, the part that makes this whole thing feel completely different once you actually understand it. So who actually paid the price for all of this? For millions of American families, this crisis was never an abstract number scrolling across a financial news channel. It was a letter in the mailbox informing them their monthly mortgage payment had suddenly become unaffordable. It was watching the value of their home fall below what they still owed the bank, a situation known as being underwater on a mortgage. Across the country, millions of homes went into foreclosure in the years that followed the crash. Families packing up homes they had lived in for years, sometimes decades, and watching them get boarded up or sold off at a fraction of their former value. Unemployment in the United States climbed toward roughly 10% by 2009, meaning millions of people who had done absolutely nothing wrong lost their paychecks simply because the company they worked for got caught in the financial fallout of a crisis they had no part in creating. Retirement accounts tied to the stock market lost a significant share of their value almost overnight, forcing some Americans nearing retirement age to delay it by years, sometimes indefinitely. Small businesses that depended on short-term credit to manage everyday cash flow suddenly found that credit had simply vanished, forcing layoffs and closures that had nothing whatsoever to do with anything those business owners had actually done wrong. Meanwhile, many of the very banks that had been at the center of creating this crisis were rescued using public money, on the reasoning that allowing them to collapse entirely would only make the damage to ordinary Americans even worse. And the small group of investors who had bet against the housing market years earlier, their prediction came true in the most extreme way imaginable. Some of them walked away with profits in the hundreds of millions of dollars. A few walked away with over $1 billion from a single trade built almost entirely on the collapse of the American housing market. It's worth being precise here about what profit actually meant for these very different players, because lumping them all together would be misleading. The investors who bet against mortgage bonds profited because they correctly identified a real, dangerous weakness in the system years before almost anyone else did, a bet that carried genuine risk of total loss if they had turned out to be wrong. Very few of them actually caused the crisis. They simply saw it coming and positioned themselves to be paid when it arrived. The banks that packaged and sold bad loans in the first place, and were later rescued using taxpayer money, occupy a very different moral category entirely, even though many of those same banks also returned to full profitability within just a few years, partly with the help of that same public support. But here's the part that should genuinely change how you think about this entire story, and honestly, how you think about the economy going forward. A financial crash isn't really an accident that simply happens to the economy, the way a hurricane happens to a coastline. In many cases, it's closer to a long overdue settlement, a moment where risk that had been quietly building up for years finally comes due, and that settlement almost never lands equally on everyone involved. Ordinary Americans had nearly all of their financial risk concentrated in the most exposed way possible: a single home, a single job, a single retirement account they genuinely could not afford to lose. When the system failed, they had almost no way to protect themselves in advance, and very little warning that anything was seriously wrong until it was already happening to them directly. The institutions and investors closest to the center of the financial system had access to information, tools, and strategies that let a select few of them either avoid the damage entirely or profit directly and enormously from it. That kind of access was never available to a school teacher in Ohio, or a warehouse worker in Texas, or a small business owner in Georgia. It required specialized financial knowledge, significant capital most people simply don't have, and direct access to complex instruments that the vast majority of Americans have never even heard of, let alone ever used. That's the real mechanism hiding behind the question in the title of this video. It isn't that some secret group of villains meets in a boardroom to engineer every crash for personal gain. It's that the entire financial system is structured so that when a crash inevitably arrives, how much protection you have and how much profit you're able to capture depends heavily on where you were already standing before the crash even began. The people closest to the center of the system, with the most information and the most sophisticated tools, are consistently the ones best positioned to come out ahead. The people furthest from that center whose entire financial life is tied up in a single paycheck, a single home, and a single retirement account, are almost always the ones left holding the risk when it finally comes due. Here's the part that makes this story matter far beyond 2008, and it's the part most documentaries about the crisis leave out entirely. This wasn't the first time this exact pattern played out in American history, and it wasn't the last. Go back to 2020, when the COVID-19 pandemic triggered one of the fastest stock market crashes in modern history, followed almost immediately by one of the fastest recoveries ever recorded. For millions of ordinary Americans, the experience was terrifying and confusing in equal measure. Layoffs happened overnight, small businesses shut their doors, and for a brief moment it felt like the entire economy might simply stop functioning. But look at what happened at the same time in the stock market. As the Federal Reserve slashed interest rates to near zero and pumped trillions of dollars into the financial system to prevent a total collapse, asset prices didn't just stabilize, they soared. Stocks, real estate, and other investments hit record highs within months, even while unemployment remained painfully elevated for millions of working Americans. The people who already owned stocks, real estate, and other assets before the crash watched their wealth recover and then grow far beyond where it had started. The people who didn't own those assets, who were living paycheck to paycheck, renting instead of owning, without a portfolio to speak of, experienced the same crisis as pure loss, with none of the recovery. Same mechanism, different decade, different trigger. The people already positioned near the center of the financial system absorbed the shock and came out ahead. The people on the outside of it absorbed the damage and very little of the recovery. This is why understanding who actually profits when the economy crashes isn't just a history lesson about one event from over a decade ago. It's a pattern that keeps repeating itself quietly in the background of nearly every major economic disruption in modern American life. It would be comforting to believe that the 2008 financial crisis was a strange, one-time failure, an unusual set of mistakes that regulators have long since fixed, and that couldn't possibly happen again in quite the same way. Reforms genuinely did follow. New regulations were put in place to increase oversight of major banks and to reduce some of the riskiest lending practices that had fueled the housing bubble in the first place. But the underlying structure that made 2008 possible in the first place, a system where the people creating risk are often not the same people who bear its consequences, hasn't disappeared. It's simply taken new shapes in new corners of the financial system in the years since. So the next time you hear that the stock market is climbing to record highs, or that some new financial product is generating extraordinary, almost unbelievable returns, it's worth asking a quieter, far less comfortable question than the one everyone else is asking. Not just how much money is being made right now, but instead, who is actually holding the risk if this goes wrong, and who has already made absolutely sure they won't be. Because when the economy eventually turns, and history shows us it always eventually does, the people who ask that uncomfortable question early are usually the ones who end up profiting. And the people who never got the chance to ask it at all are almost always the ones left to pay for it. If this kind of story, the hidden systems behind how money actually moves in America, is something you want to understand more deeply, this channel breaks down exactly these kinds of stories on a regular basis. Hit subscribe so the next one lands in front of you the moment it's out.